Income and growth investors are two different types of investors with different investment objectives and strategies when it comes to investing in the stock market. And in this video, we are going to dig deep and find out what the better investment long-term would be, SCHD or JEPI. Income investors are also known as value investors. They're primarily focused on generating a steady stream of income from their investments. And these investors typically look for stocks and ETFs that pay a high dividend yield and have a stable financial position. The main goal of income investors is to generate a regular income stream from their investments, which can be used to meet their financial needs, such as paying for retirement expenses or just everyday living expenses and bills. Generally speaking, income stocks and ETFs tend to be more established and have a history of paying dividends. They also tend to be in matured industries, having low growth potential, and are less likely to experience significant price volatility or lower beta. Some other examples of income stocks and ETFs include things like real estate investment trusts, JEPI, Q-Yield, and others. Now, what's also interesting when it comes to income investing in income stocks and ETFs, normally you don't see that many young investors investing in this type of strategy. Because after all, while you're young and you have time on your side, it likely is a better idea to buy into things that have much more long-term growth potential down the road because time is on your side. Where when you get older or closer to retirement, a lot of investors turn their strategy towards income-generating assets because at that point, they don't really have as much time left, and it might be a good idea to start generating some income from their assets. These investors are focused on investing in companies and ETFs that have a potential for significant growth in the future. We're talking 8% per year compounding or above. These investors are less concerned about generating income and more interested in capital appreciation. These growth investors do not really care about dividend yields, even to the point where a lot of growth stocks and ETFs out there have little to no dividend yield at all. Growth investors tend to invest into companies and ETFs that are in emerging industries or have disruptive technologies that have the potential to absolutely transform an entire industry. In general, growth-oriented stocks and ETFs are in high-growth industries and have strong growth potential. They may not pay any dividends at all, like we said. And this is partially because they reinvest their profits into the business to continue to drive more and more growth. Growth stocks are often associated with companies in technology, healthcare, biotech, etc. Growth investors are willing to take on more risk and volatility in the short term in exchange for a potential higher return in the long term. These investors are typically focused on the long-term capital appreciation and are willing to hold on to their investments for an extended period of time because, again, there might be a year, 2 years, 5 years, 10 years down the road where the market trades sideways, and these growth assets will not even pay a dividend in some cases. But put simply, income and growth investors have different investment objectives, and it's important to know what your strategy is going to be when you are choosing which stocks or ETFs to invest into in the stock market. So now the age-old question, what is a better investment, JEPI or SCHD? So first off, let's go over what SCHD and JEPI actually are. So SCHD, the Schwab US Dividend Equity ETF, is an ETF that tracks the Dow Jones US Dividend 100 Index. This index tracks 100 high dividend yielding US stocks, and SCHD aims to provide investment results that correspond to the total return of the index. On the other hand, JEPI, the JP Morgan Equity Premium Income ETF, is an actively managed ETF that seeks to provide investors with a high level of income by investing in US equities and options on those equities. And keep in mind, SCHD has been around since around 2011 and JEPI since around 2018. Now going in and comparing SCHD and JEPI's objectives, they do have different objectives, but both SCHD and JEPI ETFs have the objective of providing investors with dividend income. However, the way they achieve this objective is different. SCHD tracks an index of 100 US stocks that have a strong history of paying dividends, while JEPI uses an active management strategy to invest in equities and options that generate income. JEPI ETF strategy is not necessarily looking for total return as much as it's looking for consistent income, where SCHD ETF's total return is much more in the crosshairs, and that's an important aspect of the ETF strategy. If we look at the dividend stats for SCHD and JEPI, JEPI first has a 12.02 trailing 12-month dividend yield, which obviously is much higher than SCHD's. The annual payout trailing 12 months is around $6.37, which is very high for an ETF that just costs around $50 per share. JEPI also pays out a dividend on a monthly frequency. And just like SCHD, the dividend is not going to be the same necessarily every single payment. Now, SCHD's dividend summary is the following: a 3.58% trailing 12-month dividend yield with $2.56 annual payout for the trailing 12 months. And again, these numbers can and will change on an ongoing basis. But what really sets SCHD apart from pretty much all other ETFs out there is the dividend and the dividend growth rate. The 5-year growth rate for SCHD is around 14%, which means just by holding onto this ETF, you are going to experience massive raises over time, as long as history is to repeat itself, which only time will tell. SCHD is also paid out quarterly, so you do not get as frequent of payments as you would if you were to invest in JEPI, but the payment frequency is sort of secondary and not necessarily the main thing you should focus on. Now, maybe what's most telling of all is when we actually stack up JEPI right next to SCHD on the charts and look at how they've performed over the past few years. So over the last year, this is total return, which means dividends included. And remember, JEPI's dividend is much larger than SCHD's, but total return over the last year, just this one time frame, JEPI returned minus 1.63, beating SCHD with a minus 5.09. But again, that's just one time frame. Over the last 3 years, though, it is a much different story. The total return with dividends included, JEPI returned 38.49% over the last 3 years, which is not really too shabby. But SCHD's 3-year total return 102.92%. Over the last 5 years, a little bit closer in the range. JEPI returned 38.49 total return and SCHD 74.53. So just within these few different time frames, you get an idea of what the total return looks like, and there seems to be a clear winner, which is obviously SCHD. So circling back to the original topic, is it better to invest in growth-oriented, income-oriented, and is JEPI or SCHD better? The real answer to that is it really just depends. It depends on the individual investor's current strategy and current goals, not just going off a total return, and obviously things can change in the future. But it seems like putting $1,000 into JEPI and putting $1,000 into SCHD, it seems like, at least if history were to repeat itself, that in 10, 20, 30 years, SCHD would probably give a much higher total return. But if you're someone like me, you like to diversify. And that's why in my portfolio, I currently hold a good amount of SCHD and a good amount of JEPI. And I will likely continue to hold both long term. If you enjoyed this video, make sure to please drop a like in the video and subscribe for more. Thanks as always, and I'll see you in the next one.